A new poll has come out and found that a massive amount of Canadians are thinking about selling their home. That could be an absolute disaster for the housing market, considering where we are in this housing bubble. And the systemic risk in the banking system continues to build whilst regulators and the Bank of Canada look the other way. And you are not going to want to miss their comments because they are utterly hilarious, and we need to remember these comments for future years to come, I think. So, poll finds a lot of Canadians want to sell their homes within the next 3 years. Just thinking about that title there, you have to think, okay, so a lot of people want to sell their homes. Could that be because a lot of people have been holding off selling their homes right now because the situation is interest rates are extremely high, so it's more difficult for people to move up into bigger, larger homes if that's what they're doing. And not only that, people are also holding out for better prices in a lot of markets because they want to sell at all-time high, and they think that if they just wait and wait and wait, the market will come roaring back. Oh, this could be an absolute disaster. So this could unlock a lot of supply. So let's see what they're saying here. Most Canadian homeowners are not looking to sell in the next 3 years, but if all of those who are planning to sell follow through, there could be a historic number of properties hitting the market, according to a new report by personal finance company NerdWallet. The study, which interviewed 1,099 Canadian adults, 749 of them homeowners, found that 20% are planning to sell their primary residence within the next 3 years. Another 41% would like to sell more than 5 years from now, and 31% are not interested in selling at all. So it gets into the nitty-gritty now. So the study used Statistics Canada's data on Canada's current population and home ownership rate to estimate the number of homes that could be listed in the next 3 years if 20% of homeowners were to sell, and found that it would result in approximately 5.4 million new listings, an average of 1.8 million listings per year between 2024 and 2026. The report notes that the greatest number of listings Canada has seen in the past decade was in 2015, when just over 1 million homes were listed for sale. And that just goes to show you that you can have a lot of supply that comes out of practically nowhere and nobody is expecting it, which catches a lot of people offside. I mean, you constantly hear from politicians, both sides of the aisle, saying we just need to build. If we just build more homes, you hear it from mainstream economists, the mainstream media. So by that alone, you should know that that conclusion of building more homes is completely incorrect. Like, that's not just going to deal with the problem. You're just tackling the supply side of the equation. You're not looking at where the demand is coming from. So, I think we're going to build our way out of a housing bubble kind of narrative that politicians love to push because it gets a lot of young people thinking, yeah, that makes sense. It's logical. But as we know on this channel, a lot of times logical things aren't always the things that are actually happening behind the scenes. There are a lot of things that influence markets that make them very complex. And you can't just say, oh yeah, we're just going to build a load more homes and that'll just solve all our problems. I mean, if 50% of the buyers are speculating or buying them for Airbnb or buying them as rental properties, corporations, then how is that going to make any difference? It won't make any difference at all, obviously. So there's a lot of things at play in the housing market. So regulator press, CIBC board on slow pace as mortgage problems persist. So this is what's going on at CIBC. Just to kind of give you a rundown of what's going on here, basically they have a bunch of mortgage risk. It's unknown exposure, in their words, not mine. It's where LTVs have gone way too high, where they've allowed borrowers to essentially borrow against their home. They've got a mortgage and the value of them actually exceeds the mortgage. So this is really interesting because an employee came forward with some information and actually put a complaint in to the regulator. I mean, the regulator ran by the banksters anyway, but you had an employee come forward, put a complaint in to the regulator about what's happening at CIBC. So it gets very interesting. With CIBC still in remediation, a person identifying themselves as a CIBC employee wrote an anonymous letter of complaint to OSFI in mid mid-June. It alleged that inside the bank, CIBC's leader had initially sought to play down the seriousness of the mortgage underwriting issues that had been discovered. You know, this kind of reminds me of like the subprime is contained when in the US you had all these mortgage underwriting issues, similar things going on in 2007, and basically everyone was like, oh yeah, you know, this housing market is rock solid here. I mean, just look at incomes. Just look at incomes. Just look how far it's got away from incomes. Of course, I'm being sarcastic there. But everybody's like, oh yeah, the housing market is rock solid, because they look at the prices and they think, well, if prices got this high, it obviously means it's on some sort of solid foundation, when it's actually the complete opposite of that. But, you know, people get it completely wrong. So CIBC has a lot of risk. There's a lot of risk with this lender particularly, and we'll get into that more as we go on through this video. So the sources say that what has transpired over recent months has not been typical, either in OSFI's frustration with the bank or in the director's close oversight of day-to-day remediation. OSFI's concerns over CIBC's underwriting lapses surfaced at a sensitive time. The regulator is already concerned about Canada's competitive housing market, with interest rates surging higher, and recently identified the potential for a housing market downturn as the most pressing of 9 key risks to the financial sector it is tracking, right? So they keep flagging this risk of the housing market. Are they doing anything about the negative amortization? No, that's a great thing. I mean, they're saying it's risky, and we'll get onto that, and you're just, I mean, you have to laugh at some of this stuff, because it's been done before, guys, and it didn't end in a good place. It was done, of course, in 2008. So the mortgage underwriting lapses at CIBC involved thousands of clients, many of whom had lines of credit that were secured against their homes. When these lines were combined with a CIBC mortgage, the total credit available sometimes exceeded allowed regulatory limits. How did that happen? And you have to think this occurred. They found this out as a audit of CIBC. So, you know, had they not been doing that random audit, because this was found in a random audit, how would they have known? And this is the thing. There's a lot of stuff which the regulators don't see, they don't want to see, because in fact the regulators are ran by the banksters. They're all ex-banksters at the regulators. So, you know, it's absolutely insane to think that they are going to put a stop to everything that's going on. Residential mortgages also make up more than half of the bank's total loan book, giving them proportionally higher exposure to home loans than any of its rival banks. And if you have money in CIBC, well, I would just make sure that you have it in a different bank, or at least diversify your banking. Just do not have all your eggs in one basket at CIBC, considering all the risk there with how they have a lack of diversification, obviously, with the mortgages, but all the problems that are going on with negative amortization at CIBC. Then you've got this that has been flagged. It really doesn't look good for CIBC, does it? So this is really interesting, because it talks about profit margins and what happened during 2020 and 2021 when interest rates were low. So profit margins that were typically around 60 to 80 basis points, or 0.6% to 0.8%, were kind of hovering in the zero range for a period of time. Not for us, but for the entire industry, Mr. Dodig said. We're still competing with formidable competitors. That's now improving. The letter alleges that, in fact, CIBC was pricing some mortgages at negative margins for several months. Home loans priced with negative net interest margins, that means they're losing money on them. The difference between what it earns on loans and what it pays for funding totaled tens of billions of dollars over a year span, the letter alleges, citing information presented to senior bank staff. My gosh, does it not look good what is going on at CIBC right now? It really just does not look good at all, does it, when you consider everything that's going on? And then we know this, I've been through this many a times, but I just want to remind you how much of the mortgages are negative amortization at CIBC. So CIBC has about 50 billion, the equivalent of 20% of its residential loan book in negative amortization, and that's gone higher. And if you compare that to TD, has 44 45 billion, and then you've got BMO with 33 billion. It's a lot more at CIBC in terms of dollar amount. So it's kind of crazy when you really think about that. And then I saw this come out with Reuters, and I just kind of had to laugh about it. How risky is it to extend Canadian mortgage amortization? So you think they would look back to the GFC and the 2008 financial crisis, but that's not what they do. So they say, how unique is the situation in Canada? Variable rate loans account for 1/3 of the roughly 1.5 trillion in outstanding residential mortgages held by Canadian banks, up from 18% before the start of the pandemic, data from Statistics Canada shows. And it's actually over $2 trillion. It got above $2 trillion. So this is actually slightly behind where it even got to. You know, the amount of growth there has been insane. It's completely unsustainable. And this is where, you know, people get it all muddled up because people think, oh, it's population growth that has done this. It's foreign investment. But we're talking about mortgages here. You know, people coming from foreign countries, people coming here and emigrating here, they shouldn't anyway be able to qualify for a mortgage immediately. You know, that's going to be 2-3 years of building up credit, or so you would think anyways. There is definitely a subprime component that goes towards that. The fact is, you've got to ask the question, how is mortgage debt growing that quick? And it's because of speculation. Rampant speculation drives these kind of things higher and higher and higher. And the rise in debt is completely unsustainable because we have not got the income growth that we can actually pay back all this debt. In fact, if you look at what happened over 2022 and 2023, still even right now, we have negative wage growth. Whether people understand it or not is a different story, but the fact is they're being destroyed, and eventually they're going to realize that when they finally crunch the numbers or when they just declare bankruptcy because they have so much debt. So the fact is, you look at the debt situation here and it looks incredibly risky, just absolutely full of risk. So, and then if you look at the stock performance of CIBC over the past year, it's currently down around 12%. But if you look at where it's at right now, it's around $54. But if you go back to 2020 and 2019, you're talking about the same sort of levels as back then. So all the growth of 2021 and 2022 has completely reversed on these banks, and now they're looking incredibly risky because it's like, hey, just look at the amount of mortgages they have negative amortization. Just look at the Canadian consumer who is living paycheck to paycheck. You know, you've just got to add all these things up, and it's not necessarily about the borrowers specifically and their credit scores, because as we've discussed many times, reports have been published in 2015 about the subprime crisis in the US, that it wasn't just a subprime event. You have a lot of borrowers that are prime. You have a lot of borrowers that probably aren't going to lose their job. However, if a lot of people have got investment properties, they are then relying on somebody else, the renter who is in their basement, or the person who is renting their house is then paying their mortgage essentially. So when they stop paying their mortgage, do they have the income to keep up with that? Probably not. And especially considering a lot of people took out these investment properties in 2021, we know that that was 30% of the people buying them. And you know, you still see people blindly investing in investment properties like here in Calgary that are negative cash flow. I mean, I recently was going through it with a subscriber and he was telling me it doesn't make sense when you break down the numbers. Why on earth would anyone buy an investment property? And you know, it's because they think, oh, you know what, it's just going to go to the moon. Prices are just going to go to the moon because there's this gap between what prices are in Calgary and Toronto. You know, it's like comparing different stocks. They're totally different markets. You know, you can't compare Toronto to Calgary. Different economies, different markets, different migration trends. But people do that all the time, and that is a big, big mistake and costly mistake in my opinion. Anyway, rant over on CIBC. So Toronto Dominion Bank, if you look at their stock, that is down around 5% on the year. And if you look at where it's been, right now it's still actually up. So CIBC stock not performing as well as Toronto Dominion Bank. And these are the banks that I've picked here are the ones with the negative amortization stuff going on. Bank of Nova Scotia doesn't have that problem, although it is seeing credit tightening. So I just want to show you this because this will just blow your mind what the regulators and the Bank of Canada Canada said about the risks. So the Bank of Canada declined to comment for this story, but in May, Senior Deputy Governor Caroline Rogers said that extending amortization is a good release valve to deal with a temporary rise in payments. I mean, that is just hilarious, isn't it? A temporary rise in payments and it's a release valve. I mean, what on earth is she talking about? It's not a release valve. It's sticking a dam there. And basically everything's just building up behind that dam and the pressure is just mounting and mounting and mounting. And then eventually that dam is going to break and it's just going to all flood into the town, crash the housing market, because these negative amortization mortgages, they've been done before. We've seen this done before in 2008 in the US, and it did not work out for them at all. The Alt-B mortgages were essentially very similar to these fixed payment variable rate mortgages, and they were an absolute disaster. And it's not just that, you know, I was talking to another guy who works at a bank here in Calgary, and he was saying that they're still waiting to foreclose on properties from 2021 and 2022 because the government said they cannot foreclose on properties. Well, a lot of foreclosures are waiting to happen right now. So there's going to be a ton of foreclosures at some point that are going to hit the market that are just essentially, they've been in the works for years and years and years, but they just haven't been able to do it because the government said, hey, you cannot foreclose on people during the pandemic. And it takes a long time for these to work their way through the courts. So you've got that happening. And then you've got the OSFI's comments, which has urged banks to tackle the risks from amortization extensions and resolve negative amortization at the earliest opportunity. What the heck is that? Just resolve it at the earliest opportunity. It doesn't even sound like it's a risk. So on the one hand, they're saying, oh yeah, it's really risky. And then on the other hand, they're saying, oh yeah, just do it whenever you can, you know, never. I mean, it's just absolutely hilarious. Canada's financial system is a joke. It's a laughing stock. And you just cannot make some of this stuff up, guys. It is unbelievable what is happening in the banking system. And I would urge you to diversify your banking. Open up bank accounts in the US with major US banks as well. So you have a bank account there outside of the Canadian system as well. You can do that at any bank in the US. You just have to go there in person, present yourself with your identification to prove who you are. You need to have diversification. I've said this time and time again, but it is so important right now to have your banking diversified, especially if you bank with CIBC. I'm not saying pull all your money out of CIBC or anything like that, but I'm saying make sure you have other options, make sure your money is insured, make sure you have all your ducks in a row. So anyway, I want to thank you so much for watching. If you want to watch more videos like this one, check out this playlist here, and also you can watch this video that I picked out for you here. If you're looking for a VPN, you know where to go. Go to expressvpn.com/marketmania. I will see you in the next one, guys. Take care of yourselves. Bye-bye.